The Indian rupee is taking a nosedive, and it's sending shockwaves through one of the biggest economies on the planet. So what on earth is behind this currency crisis? Let's get into it.
Okay, first, let's just look at the raw number. As of January 13th, 2026, you need more than 90 rupees to buy a single US dollar. And look, this isn't just some daily dip, this is a record low. And that has some serious real-world consequences for everything from trade to inflation.
So the big question is why? What is driving this pretty dramatic slide? Is this a problem that started in India, or is it about global pressures, or more likely, is it just a messy combination of both? That's what we're going to figure out.
All right, first up, let's look at the immediate forces that are really hammering the rupee right now.
$18 billion. Think about that number for a second. That is how much money foreign investors pulled out of Indian stocks in 2025 alone. When that kind of cash just up and leaves a country, it's basically a massive vote of no confidence from the market. And when that happens, the currency's value just tanks.
But, it's not quite that simple. Yeah, the rupee fell almost 5% against the US dollar, but look at this chart. It held its ground against the Japanese yen, and it actually gained on the Australian dollar. So what does that tell you? It tells us this isn't just about a weak rupee, it's also very much about an incredibly strong US dollar. So, to pull those threads together real quick, the immediate pressures are a record amount of cash flying out of the country, a dollar that's strong everywhere, India's central bank deciding to let the market do its thing, and of course, a massive bill for imported oil, which you have to buy with, you guessed it, US dollars. Now, all those market forces we just talked about, they're being thrown into a pressure cooker because of a major geopolitical fight. The trade dispute between India and the United States, which just keeps getting worse. And the absolute heart of that conflict is right here, a 50% total tariff. That's a huge number, and it's been slapped on a whole range of Indian exports by the US. A trade barrier like that just creates this enormous cloud of uncertainty, and it makes investors really, really nervous about India's whole economic picture. So how in the world did we get to 50%? Well, it wasn't one single move. It all started with this base 25% reciprocal tariff. Then, in August 2025, bam, another 25% got tacked on as a penalty because India kept buying Russian oil. And now, there's a new threat of even more tariffs if India does business with Iran. It's just been a steady escalation, one step after another. India's position on this is, well, crystal clear, and they are not backing down. They've officially called these tariffs unjustified and unreasonable. They're arguing, look, we need access to affordable energy for our massive population. So this isn't just some economic squabble, it's really a fundamental clash of national interests. And India isn't just taking this lying down, not by a long shot. They are aggressively trying to find new friends, right? They're pursuing new trade deals with Britain and Oman, and there are more talks happening with the EU. Plus, there are these reports, which are officially denied, by the way, that they've hit the brakes on a massive $3.6 billion defense deal with the US. This is high-stakes strategic hardball. Okay, so let's zoom out a little bit, because this crisis, it's not happening in a vacuum. There are these huge global wildcards, especially in the energy markets, that are playing a massive role in the rupee's story. This chart right here, this shows you India's Achilles heel. The country imports over 85% of its crude oil. And since oil is traded everywhere in US dollars, anytime those oil prices spike, India has to go out and buy more dollars. And that puts direct downward pressure on the rupee every single time. And the situation in Iran is the perfect example of this. On one hand, if there's instability and oil supplies get disrupted, prices could just surge, maybe to $120 a barrel. In that world, the rupee could fall all the way to 95. But on the other hand, what if a stable new regime leads to sanctions being eased? Well, then you could see more Iranian oil flood the market, pushing prices down. And that would actually strengthen the rupee. Two totally different futures hanging in the balance. So we've seen the immediate pressures. We've seen the geopolitical fights. But why is the rupee so vulnerable to all this stuff in the first place? Well, the root cause is a really fundamental economic problem, the twin deficit challenge. To put it simply, a twin deficit means the country is basically living beyond its means in two key ways. First, the government is spending way more than it's bringing in through taxes. And second, the country as a whole is importing more stuff than it's exporting. It's like burning the candle at both ends, and it's just not stable in the long run. And this creates a whole cascade of problems. This condition naturally pushes the currency down, it fuels inflation at home, And the government has to borrow so much money that there's less left over for private companies to invest and grow. They call that crowding out. All of this makes the country dangerously reliant on foreign money and just wears away at investor confidence.
So, given all these powerful competing forces we've been talking about, what does the future actually hold? Let's see what the experts are forecasting. Just take a look at this table. I mean, the forecasts are all over the map. You've got UBS seeing the rupee getting even weaker, hitting 92 by March 2026, but then HSBC thinks it could actually strengthen to 88. Fast forward to the end of the year, Bank of America is pretty optimistic at 86, while Standard Chartered is way down at 93. The big takeaway here, even the experts who do this for a living are completely divided. So, what should you be watching? If you want to get a sense of where this is headed, these are the key things to keep an eye on. Number one is what happens with those US-India trade talks. Then, you've got to watch whether that $18 billion in foreign investment starts to flow back in. And finally, you have the central banks, what the RBI and the US Fed decide to do, and of course, the ever-volatile price of crude oil. Which really leaves us with this final critical question. India is making some big strategic moves, trying to de-risk its economy. But in a world with a super strong dollar, constant trade wars, and geopolitical wildcards, is it going to be enough? Or is this constant, nerve-wracking volatility just the new normal for the Indian rupee? The answer to that is going to define India's economic story for years to come.